The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Another tough day in the grain and oilseed markets on Wednesday. The soybean complex was actually the downside leader, but still just a tough look in wheat and corn. Slight bounce in crude oil, but the energies and outside markets were kind of quiet. Livestock was mixed. Just feels like it's a tough go right now as we work through midweek. Let's talk about it and try to put some perspective on things. Mike Zuzolo, Global Commodity Analytics, is with us here today on Market Talk. And Mike, good to have you with us again this week. All in all, we were chatting about this a little bit before we went on the air, and I know we're going to dive into some of the technical picture, the fundamentals here, but it just feels like in the case of the funds versus the fundamentals that we talk about, the funds are really beating up these grain markets hard ahead of next week's USDA reports, Mike.
Yeah, I mean, it feels like from a supply-demand standpoint that if you talk to anybody about the supply-demand, they don't want to talk about the strong corn demand. And it's kind of a kitchen sink bear. In other words, they're throwing everything bearish at the market possible that they can think of, including crop size, Jesse. And we have to remember, going back to earlier this week, crop conditions actually went down surprisingly, and parts of Iowa and Missouri have gotten 5 to 7 inches of very unwanted rains. And so I probably have talked to a dozen clients just in the last 3 days on both sides of the Corn Belt, both sides of the Mississippi. And I would say 2 to 3 of them see record yields. Those are going to be the farmers that are right outside of Chicago. By default, it just had to happen this way this year, where you had a situation develop where the almost perfect crop is being grown from essentially Cabery, Illinois, down to Kankakee, and just out on the outskirts of Chicago. I'd say another 2 to 3 would say, look, it's really good. It could be record. I'm not there yet. But the other 50% of the group that I've talked to so far this week has said very bluntly, I've got a lot of holes in my corn. It's not even. I've replanted corn, and my beans look atrocious. I talked to a client in South Central Indiana right before you and I jumped on together, and he said, my son's been back here with me for several years, and he just got done spraying all the beans. By far the worst crop he's seen since he's been back for the last several years. The trade's not trading that, in my opinion, and this is where it goes back to exactly what you said a minute ago, what we talked about last week and the week prior about the crude oil and the funds versus the fundamentals. We're seeing the exact mirror opposite image of what we were hoping by not seeing the crude oil go up, and instead the crude oil gets slammed by the high frequency and what I suspect are algorithmic fund traders.
Let's dive into that a little bit. I'm glad you brought up crude, and I know we have some charts to kind of break this down and support it. And obviously crude this week, with everything going on in the Middle East, kind of took that key bearish reversal on Monday and has just moved substantially lower, back down to kind of support around that $64 a barrel mark, I believe. And I think a lot of that's tied in with the commodities as well here, Mike.
I do too. I think that as we had talked about the commodity index funds and the fact that the crude weighs heavily either on the upside or the downside when it comes to the other commodities, that we are trading a lot of energies in the grains and soy. The obvious reason being soybean oil and ethanol and sugar, and even the wheat market they see as an energy market as well, because of the linkages, the historic linkage between crude oil and wheat. And so this chart, I've been talking to clients and subscribers since Sunday night saying wheat is going to be led by the crude, corn is going to be led by the wheat, beans are going to have to probably be pushed down if the wheat and the corn can't go any higher, because we just got off the 1080 mark in soybeans and it seemed like it hit a brick wall. But this chart really is why I say what I say. It backs up the analysis that I do fundamentally, and it shows you the bottom part of the chart, those yellow bars, is a 3-week correlation between lead month soft red wheat, lead month crude oil, WTI. And we're now sitting at about a 91% positive price relationship. So just about as close to 1-to-1 as you can get at this stage of the game, Jesse, with what the crude oil market's doing and then the linkage with the soft red wheat.
Let's weave in some of the financials here too, and let's talk the U.S. dollar and emerging markets funds, the ETF, and with crude oil here, and looking at some different wedge formations potentially. But I think as well we have to put the financial side of the stock market into perspective with everything that's going on as well, Mike.
I do too. And I think this is the heartbeat of the commodity market, or one of the heartbeats that I will show you and the video people watching. But I've got several other heartbeats that I keep track of that are more proprietary. But this is the mindset that the trade has right now. And historically, you have the crude oil price in white. And notice on a monthly basis that crude oil market is still up on a monthly basis. You have the in yellow, the bars, the emerging market, the MSCI emerging market ETF. That's a good gauge of the health of the emerging markets. You notice the white WTI crude oil line and that yellow bar chart, they tend to move very much lockstep with one another. When one goes into a trading range, like we did in 2018 through 2020, the other one goes into it. Similarly, when we blasted higher because of the pandemic, we see both of those rallied. And similarly, when we went back into a trading range after a big break in the emerging markets, crude oil also did the same thing. And so those two, the white and the yellow, move very one-to-one with each other. What we don't see typically is the dollar market move one-to-one and in a same direction as the other two. And we've picked that up again. So the dollar just made a new 27-month low this week, Jesse. It's not being bought as a safe haven, and it wasn't really being bought that aggressively in the midst of the Iran-Iraq conflict. And after the nuclear sites were taken out by the U.S., yeah, it jumped 1-2%, but it wasn't like I was expecting it. And now we're back on the downtrend in the dollar, and we have not lost any support, any traction at all for the month in the emerging markets. And so my take is very simple. With that correlation we just showed you, and you add to this chart, if the crude oil can find some stability going into the end of the week, and especially the end of the month on Monday, and the emerging markets stay strong, I really think the commodity sector as a whole has been way overdone to the downside at this point. It doesn't mean we're going to go shooting sharply higher in the crude oil market. It just means we've got a discount in the grain markets, especially those grain markets that have the strongest demand.
On the wheat side here, looking specifically at July SRW, I know we have wheat harvest here. The U.S. is progressing along now rather quickly. Maybe some minimal production concerns with weather in some areas of the world, but I feel by and large, wheat complexes and the supplies are looking good. I mean, what are you tracking more broadly in the wheat trade, Mike?
Yeah, there's no question that the problems in Russia that we've been talking about have been completely thrown out the door, with private estimates now going higher. One estimate going up by, I think it was 4 or 6 million metric tons. Another private estimate just raised theirs on Wednesday. And we're dealing with 84 million metric tons in terms of the Russian crop. The Chinese have also been talking about how they're going to have a record potential crop, or at least at the very top of the 5-year average, even though we've talked about and shown the drought situation over there right up against harvest. So we are back into getting fed. Very bearish news. The market is not fighting that at all, even though the satellite imagery, what I've been showing you the past 6 weeks, would suggest don't buy into it. They're buying into it, and that's because of the crude oil market. So the natural question, as you say, if we are now in a seasonal weakening time period with all of Northern Hemisphere on a wide open harvest, when will that harvest seasonal probably find a bottom? Well, looking at the last 6 years, it really comes around by the second week of July in many of these years that we're looking at on this seasonal chart. We're tracking again very much like 2024, now that we've found a price cap as of a couple weeks ago. But I would also say what's not on this chart is 2015. We're tracking very closely with 2015. So why I'm telling you about this chart and the listener about this chart today is because if we find a low in the crude oil market, that could, and I think should, set us up for a seasonal harvest low in the wheat as we get into the first or second week of July. So that's what I'm going to be looking for, especially if we stay weak on that U.S. dollar.
Mike Zuzolo, Global Commodity Analytics, joining us here for market analysis today on Market Talk. As again, at midweek, just a lot of pressure in this grain and oilseed trade. Let's talk corn a little bit here, Mike. And you mentioned this earlier as we think about the demand story for corn. Yet that's not really moving the needle here to the upside. And I know, in fact, on Dees corn, we broke through a key support level here this week. I mean, when you look at this corn complex, I know a lot of producers are frustrated. What are you watching?
Yeah, this is the chart that I send them ahead of the grain acreage and grain stocks report on Monday. And we have to remember too, Jesse, Monday is when July futures is the cash price around the country because it's in delivery. And that's where in the delivery process, since it's still physical at the mercantile exchange for the grains, the seller has the option to go ahead and deliver against the CME cash, the CME price, I should say. So if the CME price has got a premium to it, the deliveries will be heavier. That tends to be a negative influence on the market. I think the reverse could be true this year because I don't think the deliverable stocks are probably out there to be delivered. And we've got a cash price way above, in many parts of the country, way above where the mercantile price is. So I'm putting more weight than normal on the corn stocks report. I know that some traders and analysts are nervous about bigger corn acres. I'm aware of that. But as long as we don't see anything outside the average trade guess of about 95.4 million planted on corn, I think that grain stocks in the corn market especially could show us some friendly price action because this export pace that we're seeing right now is about running on inspections and sales. It's running about 30% above last year. USDA only has us up 15% for the whole marketing year, and we've still got 10 weeks left in the marketing year. We've essentially met now the USDA estimate on sales, and we've still got about 10 weeks left. I don't look for a lot of cancellations because other than Argentina being a few dollars cheaper than us, we are well below Brazil, and we are the cheapest corn crop price out there when it comes to what is priced at the Gulf and at the Pacific Northwest. So the key number for me on Monday is going to be, are we at 4.6 billion bushels of corn stocks? Is that going to be 7+% lower than last year at this time, or could we even be more than that? And last year at this time, we closed the week out at around $4. So we're only roughly a dime away from that after Wednesday's low.
Should ask you soybeans. I know, again, they were the downside leader on Wednesday. I feel like we're nearing some chart support again, maybe just taking some risk premium out with all the rain you mentioned we're getting across the Western Corn Belt. I didn't see anything else on Wednesday to necessarily drive soybeans lower. I think it was just funds maybe attacking that market a little harder on the day.
I agree with you 100%. What I did see was the bean oil, when the crude oil went up $1.50, the bean oil turned positive, and it looked like the soybeans were going to try and fight it. But then the crude oil turned negative again, and that kind of assured me that my theory about crude needing to bottom first is still in play here. And I think that's what really sunk the beans. Beans, I think, are simply playing catch up with the corn and the wheat because they hung up there so high. It wasn't long ago we were at 1080 in beans, and I was scratching my head saying, why are we at 1080 in beans? Either the corn and wheat have to go up or the beans need to go down. And so I'm in a situation now with producers that maybe had July options instead of SEP or November options underneath them for floors. I'm in a situation now where I've got to wait to the June 30th crop reports and then let that July bean go into delivery. And if I don't find any kind of daylight led by the wheat and the corn, I have to get them covered up with some floors again, because I do think the soybeans, even though they look rough, and as I said, that Indiana client said one of the worst in many, many years at this stage, I still think floors underneath you in beans are a minimum of what you want to do in a market environment like we have right now.
Let's go to livestock and let's take a look at the cattle complex and look at the chart that we've been tracking for a few weeks now, comparing boxed beef with live cattle futures. Markets a little mixed, I would say, at midweek overall, Mike. But again, I think this is a market that's maybe getting some fund pressure and getting a little bit tired, at least on the futures side.
Yeah, and I think the live cattle market right now has an immense number of tailwinds that I'm hoping really generate some upside as the June contract goes off on Monday and probably can't be traded after Friday, would be my guess. And then we see the August take over at a substantial discount. But you've got the August right now at 221 versus a lowered negotiated cash price, probably around 230. You might be able to find some 235s out there in the Western Corn Belt or in Nebraska, but I'd say negotiated cash has dropped from about 238 down to 230, but that's still almost a $10 premium to the June fat cattle. August is another $10 cheaper. Then you've got the lower gasoline prices that we don't have to worry about high gasoline prices this summer, it looks like, because of what the energies have done. Then you've got that 27-month low in the dollar, which should keep our exports up and our imports kind of pinned down. And then you've got record high stock prices with the S&P 500 within earshot of going above its record high this week. And so you've got an immense number of tailwinds in the live cattle here in the short term. I'd really like to see one more bump up in the fats. It just goes back to the feeder cattle. They're the ones that are really a question mark, and it goes right back to when does that U.S.-Mexico border open up? We're right up against the end of the month. We got to be watching out for that.
Well, and thinking about feeders, one more chart for us to look at here, the feeder corn ratio, and with corn breaking some support, I know cash basis for corn in some areas is starting to poke below and get into the threes in the I states and things like that. I mean, could a lower corn market here in the short term help support a feeder market that's maybe getting a little concerning?
Yeah, I think it could, and I think it has been, Jesse, and I think the funds are still playing very heavily at that. And you can see that by the white line, the ratio between the corn and the feeders. If you divide the feeders into the corn, you're talking about being at 73.5. Feeders are 73 and a half times the price of corn. We have now, if we close at this level on the month of June, we will have taken out the highs from 2014. This is one of those big check boxes that I've been talking about with the feeders that I would want to be watching very closely. And so, yeah, short term, the corn market should be very good for the feeders. I've also seen 7-weight feeders sell on Wednesday in Bassett, Nebraska. Light 7 weights going for $366 on the steers. I mean, it's still a very friendly, supported cash steer market out there for the feeders. So I feel like we've got a lot of good things going for us other than that potential screwworm news here at the end of the month. So I'd be watching for rallies, and those rallies, like we did last time, get them hedged, get some floors underneath you. I've not really changed my mind much in the last month. I still want to be really protective of the cattle and protective of the soybeans.
How about that hog complex? I know Monday we moved higher. Tuesday we gave it back. Wednesday, kind of a mixed bag, maybe some positioning ahead of the quarterly hogs and pigs report that's out on Thursday, Mike.
I think that's exactly right. I also would say that we've gotten that carcass price up to about 2022 levels. It's been running red hot. It just needs, I think, some bullish news to feed it at this point. And we also have, as you say, the cold storage report Wednesday, and then the hogs and pigs on Thursday. Big number on Thursday's report is I was surprised the marketing's average number wasn't better than 100%. It was like 99.6. I would have thought the pork chop and bacon and all the competing proteins out there with beef would be running red hot this past month. So I'd be looking for a number over 100%. I'd be disappointed if it wasn't.
Mike, great analysis as always. Final thoughts, anything you'd mention or reiterate for folks today?
If you didn't pick it up in the commentary, Jesse, between the weak dollar and the crude oil association with grains, we really need this market to turn around either right before or right after July 4th. After that, I'm going to have to rip up the analysis and start all over again. But so far, so good as far as tracking with what I've been projecting out.
Mike, if folks want to reach out for a conversation, what's the best way?
Best way is globalcomresearch.com. That's globalcom with 2 M's research.com.
Mike Zuzolo, Global Commodity Analytics. Always a pleasure. Thanks for joining us on Market Talk. Have a great week, and we'll talk to you next week.
You too, Jesse. Thanks for having me, sir.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.